Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Today's episode, we don't have a guest. We're going to be talking about a company. We're going to use the framework, the GW Investment Institute framework, business management, price valuation, and balance sheet. We're coming to you from the studio here in the GW School of Business. I have my trusty mug right here. Merch available. Link below. Just kidding. No merch yet. Go to the bookstore if you want some merch. All right. So today's episode is going to be on the company Nike. Nike is not a large holding in our portfolio, but there's been a lot of changes at Nike. So I think let's take some time to go over what's happening at Nike. And I think everybody knows Nike, and I wear Nike Air Force Ones on campus, for those of you who don't know that are customized with the GWU on the bottom. I'm a little bit biased, but that's separate from, as a customer, this as an investment. So as an investment, we really need to think about, what's good for us as shareholders, right? And we really need to understand the company from that perspective. So if we look at Nike, I think most people really understand what Nike, the business, is, right? It's really about the shoes. It's about the apparel. It's about the brand. Started a long time ago by Phil Knight. But let's get into the framework. So we got business, we got management, we got price valuation and balance sheet. That is the GW Investment Institute framework that we evaluate companies with. And again, this is not investment advice. This is for informational, educational, and entertainment purposes only. So let's dive into the business. So when we talk about Nike, the business, let's talk about the overall company. What is the market cap for this company? Well, it's a very large company, so I think it's worth, really trying to understand, what, size of the company this is. And so the market cap is 116 billion, market cap. So that's a very large company, but not astronomically large when you compare it to the tech giants that are in the trillions of dollars. And so when you think about Nike, you think larger than life, Nike, the brand. But when you look at it as compared to, let's say, a tech company like Apple or NVIDIA or Microsoft, that are denominated in trillions, and Amazon, as an example, Nike would be a much smaller company in comparison to those tech giants. But certainly the brand of Nike is enormous, and people know that. And again, started way back in the day by Phil Knight. It really started as Blue Ribbon Sports. Shoe Dog, if you're interested in a biography, is very good overview of the history of Nike. But let's talk about Nike today. So the business, we're talking about selling shoes. We're talking about selling apparel. We're talking about, again, equipment. But really it's about the brand, and it's about, how people perceive that brand. The Just Do It has gotten very famous, and of course, their key spokesperson for a long time, Michael Jordan, which continues to be a huge part of their business and is now a separate brand, the Jordan brand. We're not going to dive deep into a lot of the different stuff here, but I want to make sure that people really understand, a very high level overview of what's happened at Nike. And so when you think about Nike, the company, you think about, well, long time ago, it used to be they distributed to a middleman, a distributor. So you think Foot Locker, Finish Line, these kinds of companies that Nike would ship to, and then they would sell their shoes. Well, now they shifted, and you can go Nike Direct. For example, the customized Air Force Ones that I purchased got online at Nike Direct and Nike.com. And so there is no intermediary. Nike is selling those shoes directly to me. They're customizing them directly for me. But it is still a huge part of their business, the old school retail. And recently, there was a bit of a falling out when Nike tried to push more through their own channels and really disrupted those relationships with those key distributors that they had in place. Now, I think they're doing their best job to repair those relationships. It still accounts for something like 60% of their revenue, so 40% now is Nike Direct. So it's a very important part of the revenue. And it's likely to be, in the future, a big part of it. Now, they're going to likely try to make it a bigger and bigger portion that's Nike Direct moving forward. That said, if that doesn't happen tomorrow, which it doesn't seem like it is, you really got to pay attention to those relationships and those sort of intermediaries that sell Nike on the retail side. And again, some examples, not including everybody, but well-known ones are Foot Locker, Finish Line, and other shoe stores that are similar. And look, this is something that Nike has to focus on. I think one of the things that they've had trouble with, and in the management is this part of it. And so they brought back somebody, Elliot Hill. So we'll get to management here in a moment. So when we talk about Nike, now let's go over some of the stats for the business, and we're going to touch on what's happening in the management. So when we talk about the stats, it is again, we talked about the market cap, 116 billion, and we look at the revenue last year, 50 billion in revenue, and that actually was a reduced size, down 2.8% for the 12 months trailing through 8/31/2024. And so through August of this year, Nike actually shrank year over year. And even if you look at for 2024 through May, you're talking about a modest increase. So really, you're talking about shrinking. And now, you're talking about Nike projecting to be lower in 2025 year over year, and a modest improvement in 26. And so that's the consensus analyst ratings here. So that's, and look, you could say it's slightly better, slightly worse, but you're not talking about 20% numbers here on the growth side. And actually, you're talking about things that are going down. So that's a real concern for the business. And so you can look at the revenue kind of flat here for the most part, slightly down. So that's not necessarily a good thing when you cannot grow the top line. Now, when we look at gross profits, it's a better story. You're looking at 44.8%, nearly 45%. And now when you look at the net margins here, you're talking 11. So you're eating up a lot of that. So these not a huge net margin business, a good gross margin business, but not a high net margin business. So when we think about the business overall, well, we talked about sort of the mix that it's had between the traditional retailers, Nike Direct now. That mix has changed in favor of growing the portion for Nike Direct. And as you can probably guess, the Nike Direct is likely going to have a higher net profit margin back to Nike because you're eliminating a step in the process here. So the more they can do that, the more they can probably improve the differences between that gross margin and the net margin. And they're going to be looking to shift that. But at the same time, they have to take care of those relationships that they've built since really the founding of the company, because that's really where their sales came from, through these intermediary retailers, not direct from Nike. That's not how they built the system. And so cultivating those relationships and making sure that their sound is going to be super important. And I think, again, this is why they brought back somebody that's been old school, which we'll talk about in a moment. But look, the stats look okay, not great. And when you talk about free cash flow, 7 billion in free cash flow, so not, with a very, very small capex here. You're talking 600 billion in capex, almost 700 billion in capex. So good free cash flow number overall, not outstanding metrics when you talk about the business. And so when we would grade the business for Nike right now, right, if you include the brand, which is obviously really well known around the world, you talk about the swoosh, you talk about the Jordan brand, Just Do It, all these things that they've built up over time, gets a very high score for the brand portion of the business. But then when you break down the specific metrics for Nike, you're not talking about great metrics. 50 billion in revenue, basically flat, now down year over year, almost 3% through August. Decent net margins at 45%, or gross margins rather at 45%. Okay net margins, not great for sure. We're closer to average business margins here at just over 11%, and decent free cash flow. So when you rate the business and we talk about the scores for the business, you're talking about a score that's something probably like a 6 or a 7 right now. I love Nike, no offense to those out there. However, the business is not doing great right now. If you have to have a very, pragmatic analysis of the business, there are a lot of concerns that need to be addressed. Again, this relationship between the retailers and Nike, this mix between the Nike Direct and the other channel, how do they manage that? How do they keep this going? The old school version with the retailers, plus making sure that they can maximize their own opportunities with Nike Direct without disrupting the sales, that's a challenge. Next, again, you're not talking about high levels of growth right here from where they are. Again, you're talking very much a slowdown. That's a big challenge. And then when you look at the gross margins, not bad, but you look at the net margins, very average, let's say, overall. And so where is the growth going to come from? You got to find those markets. Is it going to come internationally? China was a big market and growing, but the economy in China has also been slowing down more recently. And so there is a concern about, okay, well, how much consumer demand is going to come out of China? And then where is it going to be all, from the rest of the world? Where's that growth going to come from? Where's the engine of growth? I think they really need to focus here on the US. And certainly, I think in the growth markets, including China, they need to figure out how to make sure that they're ready and prepared to address those when they do turn, because it's likely that they'll turn. I think they're going through some rough patches, but Nike's going to be around next year and the year after, very likely. How do they position themselves, which I think rolls into the next part here, which is on the management side. So they brought back Elliott Hill, which is a kind of a lifer at Nike, if you like, somebody that's been there a long time, but they just brought him back this year, just recently in October of 2024. And I think part of that is because they seem to be struggling to find their footing, pun intended, to find their footing and the mix between these two channels that we talked about, the retailers versus direct, Nike Direct. And so we'll see what happens here. I think Elliott Hill certainly has this culture in him, and he was at Nike for a long time, and certainly can bring back the elements that have made them successful in the past. Now, is it all going to work out? Time will tell. He's only been in the seat now just a couple of months, and we'll see how this turns out. We're going to have to pay close attention, us at the GW Investment Institute and our analysts, to say, well, what are the earnings going to be looking like? And what's this effectively a turnaround story at this point look like moving forward? It's something that we're going to have to pay attention to. It's something that our analysts are going to have to pay attention to. It's not a huge position in our portfolio. We did own before and sold in one of our portfolios. We do continue to own it in another one of our portfolios. And so we'll have to see how this plays out over time. Not a huge position for us, but it is something that also analysts are watching for. Is there a prospective buy-in here for one of our investment institute portfolios? Because maybe Mr. Hill will find a way to turn these things around and make a big difference at Nike. So on the management side, I think they really do have to figure out what Nike is going to be in the future. Now, bringing back somebody from the past certainly has its benefits, but it also could be an inhibitor to what's next. Now, we'll have to see. It's been a few months. That doesn't necessarily mean anything yet. That said, I think when you rate the current management, the CEO and the group now that he has inherited and will be building around him, I think it's early days, even though it's an older person, a person who's been rather in the company for a while. That said, I'm still thinking that's like a 6 right now. And the verdict is out whether this old school new management will work out and pay these benefits for the management team. So I think that's closer to a 6. So, all right, now let's move into the, the valuation piece of Nike. So when we talk about the valuation piece of Nike, all right, what's the, and we can use PE. This is an established business, and so we'll overuse PE for a lot of these episodes when we go through this framework, and we do that in our classes as well. But when you talk about the price earnings ratio, this is also not a cheap business right now, right? So you're talking about the PE right now is 28 times. So you're kind of right at the S&P and a little bit higher actually than the S&P at the moment. And so you're paying a small premium to the S&P. Nike has a great brand, but it's in a challenging situation right now. So I'm not quite sure whether it deserves, and again, huge Nike fan, just to be super clear, as a consumer and personally got my Air Force Ones on right now, customized for GWU. However, should we pay this premium? I'm not convinced. Not necessarily are we convinced at the moment that Nike deserves this premium where they are. Now, let's see if the management team can revitalize, refix, recharge, reset, and get back in there with something. But right now, that premium does not look deserved. We'll have to see. Now, where has it been over time? So let's say the better news about this is that over time, you're talking about a median of 33 times. And so when you look at it that way, it's kind of trading at a discount to where it has historically over the last 10 years. And so that makes it a little bit more palatable, but interesting nonetheless that it still trades at a small premium to the S&P, but a discount to its long-term average, the median, at 33 times approximately. So, but it's been much higher. You're talking about highs of 78, but a lows of of 19 over that same 10-year period. So you're on the lower side of this overall. And again, discount to the 10-year average. So people right now are saying, okay, well, the market rather is saying that, and the people that make up the market are saying that Nike should be at a discount to its 10-year average because of some of these issues that are in there. And I would very much agree with that, but I would even say maybe it's a little pricey at the moment from here. Again, I think time will tell. It is, I think, an interesting story to follow because it does have such an iconic brand. It does have such a rich history, and it has great distribution, even though that they've had trouble with this a little bit between their traditional distribution channels and their new distribution channels. Nike is all over the world, and can it make a comeback? I think it can. It certainly has, all sort of the DNA within the company to do such a thing. And let's see if the old management now that's the new management can turn this around and make this happen. Just do it. That's what we would say to the old management team that's new. All right, so that's on the valuation side. The valuation is okay. Let's say I'd say that's also a 6 right now. You're not going to get a really high rating when the other metrics are not looking great and you're trading at a small premium to the S&P and a small discount to your long-term average. So I would say that's kind of a middling number. Let's call it a 6 at that. So the scores are right around 6, let's say, overall for the categories. But now let's move on to the balance sheet. This is the last component in the GW Investment Institute framework, the balance sheet. So this is important because we want to understand the risk on the balance sheet. At the Investment Institute, we are equity holders. So we have to make sure that if there is debt on the balance sheet, that we understand what it is and that we're, aware of the risk that we're taking because, if you've followed any type of equity holdings or companies, that if there is a bankruptcy, if there is a really bad situation, that equity holders generally get wiped out. There are different cases and can be restructuring and sometimes you get something, but for the most part, you have to consider as an equity holder, you're going to get wiped out. Now, specific to Nike here, let's look at their balance sheet, all that said. So they have about $10 billion in cash and about $12 billion in total debt. So net debt of $2 billion. For a company the size of Nike, generating $50 billion in revenue and $7 billion in free cash, that $2 billion of net debt is not a huge concern. It's not something that we're super excited about, I would say that, but it's also not something where, okay, we're going to lose a lot of sleep at night. So something to watch, if they start issuing a lot of debt, we'd have to really pay attention. If you look at the interest coverage ratio, which is time interest earned, you're talking something that's around 25 times. So that's something that is not something that we're super concerned about. Again, sort of the net debt of $2 billion and 25 times interest earned or interest coverage ratio, which is EBIT over interest. All right, we're not terribly concerned. It's something that we should be watching. It's something that won't keep us up at night. However, it is something that we have to pay attention to. It is something that we have to really focus on, that the new management team, if they have some sort of expansion plans, are they going to really increase that and make that an issue? Now, we don't have anything necessarily to think that that's the case right now, but it is something that we have to monitor. It is something that we have to watch. It is something that we're going to have to really maintain and think about. So, balance sheet. Let's score the balance sheet. The balance sheet, that's probably slightly better here, a 7. I'd really love to have a net, cash position than a net debt. But when you talk about 25 times interest covered, again, earnings before interest and tax over interest, that's the calculation, about 25 times right now. We're not losing sleep at night for that. But it is something that we need to watch as analysts. We need to pay attention to that. What's management going to do? Dramatic expansion plans? Doesn't look like it at the moment that would ramp up that debt, but let's see. Maybe in a different interest rate environment, that would change. So we have to keep an eye on that. So let's pull it all together. You're talking the business. Again, iconic branding. The swoosh, Just Do It, Jordan, Air Force Ones, which I'm partial to. All these things are great on the brand side now. If you look at the metrics, though, when we talked about the business, $50 billion in revenue, year-over-year decline in August, modest decline, but a decline. You talk about the gross margins, good. You talk about the net margins, average. You talk about the distribution channels and the challenges between the traditional channels and the Nike Direct, needs to be solved. That gets you a 6. You move on to management. You got old management that's now new management. So I think it's important what the new management, which is the old management, Elliott Hill, is going to do. However, time will tell. Maybe this is the person to come in and right the ship, and Mr. Hill will sort this out and bring back that culture and make sure that Nike gets back on track and make sure that Nike is dunking on the competition, so to speak, moving forward. Still a 6 right now. I think it's a to be determined. And so you're at 6 and 6 business management. You look at the price valuation. I think that's also a 6 when you talk about, again, trading at a discount to the 10-year number, 28 versus 33, but really a small premium to the market. So, or you can even say, well, it's on top of the market. Well, with all the challenges, I think that's maybe a fair to slightly modestly, increase valuation that we should be willing to pay for, but it's something to watch. It's not super expensive, again, relative to its own history, but it's definitely not, cheap by any any standard rather. So now that I would call that also a 6. And you move on to the balance sheet, as we talked about, net debt of $2 billion, 25 times coverage. Maybe that's a 7. So that kind of all works out to somewhere between a 6 and a 7, a 6.25 if you like. That's an okay score. I think it's something that we should be paying attention to. Nike is a company that is a small position in one of our portfolios, and I think it's time for us to really watch and see what this new management might do. Can they solve some of these obvious challenges? Where are the growth markets going to come from? Is it going to come from China? Sort of a resurgence of Nike's brand in the US? Time will tell. They get these channel distribution systems sorted out. The old management reestablishes that great culture at Nike and brings that back. We'll see. Just do it. Again, is what our advice is to the new management team. That's the old management team. Just do it. Now, all that said, again, this is for entertainment purposes only and educational purposes only. We hope you enjoyed this episode. We look forward to seeing you back on the next episode. That is a wrap. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.